Hey, what's going on? This is Stephen Place with Precision Volume Alerts, and today I want to talk to you about the major mistake I see so many option traders making right now. We will see instances where a lot of folks will buy a certain kind of option and they'll lose all their money, and that's when the stock starts to make its run. So to illustrate this point, we're going to talk about PLTR. And this is a stock that, I think it's due for a move. I think we can see a nice little push and maybe a crack above 30. The problem with PLTR right now is that it's a very crowded trade, and this is because a lot of people saw very good earnings and it had a nice little gap up from 22 up to about 24, 25. So what happens during this time is a lot of folks out there want the next GME. They want the stock that'll move from 50 bucks to 400 bucks in 3 days. So they go out and buy a bunch of weekly call options. And what'll happen is that the stock will fail to move higher because it's so crowded. So many people bought weekly call options with very high implied volatility that it puts a cap on the stock. And I think that's what happened with PLTR last week, where a lot of people were looking at this earnings report. They were thinking we were going to go mooning higher, up back to, $30, $32. And they bought a bunch of weekly call options. Now all those call options have expired, and that kind of uncaps the stock. So when you think about the kinds of trades you want to take and the structure that you want to take with them, you probably don't want to focus on weekly call options unless you've been magnificently successful with them after February. Okay, so this is after everything is running. Unless you've been very successful with them, odds are you want to go longer duration. And that's one of the ways that you can really get an edge, because what will happen into these kinds of moves is that implied volatility on weekly options will go crazy because everyone and their mother is buying out of the money weekly call options, and then that puts a cap on it. But if you go further out in time, those options tend to be a very good value. They tend to be a little bit more underpriced relative to where the stock can go, and a lot of these stocks can explode higher, where you're earning returns of potentially 300 to 1,000% on those call options. So the big lesson right now is think very hard about how long you want to have that optionality. How long do you want to control those shares? Odds are for something like PLTR, it's going to be longer than 5 days. You need to look at something a little bit longer, maybe 60 days even, because the 60-day out of the money call options may be a much better value right now than trying to absolutely nail this rocket ship higher and buying weekly call options. So that's the first part, all right? And that is the duration, or what we call the tenor in the options market. There's also the second part, and that is what strike price to select. The best thing you can do there is to say what price levels will have the highest odds of being touched, and that's how you can then structure your trades. Now, it's easier said than done, isn't it? And to help you with that, I've put on a free training talking about how we use our roadmap to identify key price levels where stocks will auction into almost as though they have no choice. So to get access to that training, it is below this video. I'm pretty sure we're going to set it up where you do your name and email, and I think your phone number to get notified when the training starts. So go ahead and do that below this video if you want to see exactly how we use our roadmap to predict where stock prices are going to. And I'll see you on the other side. Take care.